In this lecture, we're going to meet the option Greeks. As we mentioned before, the option Greeks are one of the bedrocks of option trading. So if you're trading options without knowing about the Greeks, without understanding the Greeks, and without creating your strategy based on the Greeks, then you're making a big mistake. So we've seen that there are three main variables that affect option prices. The first is price movement of the underlying stock. The second is implied volatility. And the third is time decay. And we have four Greeks that quantify each of these parameters. Now, options are mathematical, so we have to always bear that in mind. The prices for options are all determined by a formula based upon these three variables. There's a total of four Greeks involved here. We have delta and gamma. Delta and gamma both quantify how your option is going to behave based upon the change in price of the underlying stock. We have the Greek vega that quantifies how your option will behave to changes in implied volatility. And we have theta, which represents time decay. So theta is probably the simplest one to understand, and delta is probably the most important one because in most cases your option is going to respond directly to delta. But all of these Greeks are very important, and we have a separate chapter, lecture on each one of these Greeks. But in this lecture, I want to go through what these Greeks are and just explain briefly, and then in the next four lectures, you're going to be seeing all these four Greeks in action on the trading platform. So delta represents the sensitivity of your option price to changes in the stock price itself. So formally, how you define delta is the amount your option will move for a $1 move in the underlying. So obviously you can imagine if you have an Apple option, for example, and if Apple moves up or down by $1, how much is your option price going to move? So that's what delta tells you. Delta also tells you your directional bias of your position. So if you have a call option or a put option, it's going to tell you how much of a directional bias you have. So, and you're going to see the delta being represented in two different ways. One is it's going to be represented as a decimal. So delta values range from 0 to 1 for calls, and they range from 0 to -1. So they're all going to be decimal values less than 1. So it'll be 0.5, 0.25, and 0.75, things like that. Delta represents the first derivative of price. So if the stock moves by $1, how much is your option going to move by? So this is the first derivative of price. Obviously, the option cannot move more than $1 because that doesn't make sense. So it's going to move a certain amount between 0 and 1 for a $1 move in the underlying. And that's why you see the values of delta is going to range from 0 to 1. And the values of delta on the put side is going to be 0 to -1 because puts move in the opposite direction. Delta values reflect the moneyness of the option. Now, what do we mean by moneyness? It's not a real word, but it tells you how much your option is either in the money or out of the money. So we have at the money options, then we have in the money options and out of the money options. And in the case of in the money options or out of the money options, how much is it in the money or how far is it out of the money? So that's what moneyness tells you. And it only is a reflection of how far the option is either in the money or out of the money. In the case of at the money, it's very clear. It is exactly where the stock price is. And so you'll see that at the money deltas are 0.5. And in the money deltas range from 0.5 to 1, and out of the money deltas range from 0.5 to 0. Delta is also a rough estimate of the probability of that option going in the money. And this is something you'll see as we go into the trading platform in the next few lectures. You're going to see how these Greeks are represented. So if the at the money option has a delta of 0.5, then the probability of that option ending in the money is going to be 50%. So we've seen that in a couple of examples. If you have an at the money option, then the approximate probability of that option going in the money or out of the money by the day of expiry is going to be approximately 50%. And if you have an in the money, this option is already in the money. So obviously its probability is going to be higher than 0.5 and less than 1. And similarly, if you have an option that's out of the money, it's going to have a lower probability of ending up in the money. Therefore, its probability is going to range from between 0.5 to 0. So that's what delta represents, and we'll see all the details in the next lecture. But let's move on to gamma. Gamma is probably the most difficult Greek to understand, because gamma represents the second derivative of price. Gamma represents the rate of change of delta itself. So what do we mean by that? What we mean is, whenever you're looking at delta and your stock prices are going to move. So let's say you're looking at an at the money call option. The at the money will have a delta of 0.5. Now, as it moves either in the money or out of the money, the delta is going to change. And, the delta is changing because the stock price is changing. But the rate of change of delta also changes. And that's what gamma measures. How much is delta going to change for a $1 move in the underlying stock? When an option is at the money, it'll have a certain gamma. But if it goes out of the money, it'll have a different gamma, and your delta is going to change either slower or faster depending on whether it's in the money or at the money or out of the money. So the way you think of gamma is, if you recall your school physics, you have distance, and then you have speed, which is the first derivative of distance. And then you have acceleration, which is the second derivative of distance. So, you want to cover a distance of 1 mile. You can go at a constant speed of 20 miles an hour, and there's no acceleration. There's no speeding up or there's no slowing down. Let's say you're going at 20 miles an hour, and then you speed up from 20 miles an hour to 30 miles an hour, and you take a certain time to cover that distance. Then when you're speeding up from 30 miles an hour to 40 miles an hour, you're going to cover that same distance in lesser time because you're already starting at 30 miles an hour. So gamma is something like that. Gamma is the second derivative, and it's a very difficult Greek to understand, but it becomes very, very important when your options are close to expiry. So you can imagine when your options are close to expiry, especially on the at the money options, the at the money is jumping around a lot because they're either in the money or out of the money. And remember, at the end of the day, when an option expires, there's no such thing as at the money. It's a binary outcome. Either an option goes in the money or it goes out of the money. So gamma becomes a very significant factor as you approach closer to expiry. This is a little bit of detail that you'll probably understand later, but think of gamma as either wanting movement or not wanting movement. So when you're a buyer of options, we know that we want movement, and we want movement in our direction. So buyers will have positive gamma because gamma is what moves the delta. So when you have a positive gamma position, you want movement. And when you have a negative gamma position, you don't want movement. So negative gamma is usually associated with an option seller's position because the seller doesn't want movement. He's perfectly happy if there's no movement in the stock. So we'll cover gamma in much more detail in the lecture on gamma, but let's move on to Vega right now. Vega represents the sensitivity of your option to implied volatility. So Vega is a number that will tell you how much your option price will move for a 1% change in implied volatility. Vega is a positive number, but if you're a buyer, you're going to be a Vega positive. And what Vega positive means is that the buyer of the option wants volatility to increase after he buys the option. So we saw in the previous lecture on implied volatility, buyers always want volatility to increase after they buy the option. And on the flip side, a seller is going to have a Vega negative position. So the seller wants volatility to decrease after he sells the option. So those are the two characteristics of Vega, and we'll see all the details also on the lecture on Vega. Now Vega is highest for at-the-money options. So just like we saw on time decay, we had the highest extrinsic value for at-the-money options. And similarly, it's the same concept here. Vega is highest for at-the-money options because the at-the-money options represent the maximum uncertainty, and they also represent the maximum of, and they also have the maximum ability to jump around. So Vega is highest for at-the-money options. And as you go out into time, if you look at expiry series that are 30 days, 60 days, 90 days out, your Vegas are going to be higher for the further out options. And that again should be intuitive because there's much more time available for these options to move around and hit various strike prices. So Vegas are always going to be higher for options that are much further out in time. And as you approach expiry, the effects of Vega actually start reducing. Finally, we have theta. Theta is the amount that an option will lose value every day due to time decay. So on all options, theta is represented as a daily value. So every day, what the theta value will tell you is the amount that that option will lose in time decay. Theta is always represented as negative numbers because all options lose value. And time decay, we've seen, it hurts the buyer, and time decay benefits the seller. Time decay is also exponential as it approaches expiry. Longer options have less time decay, and time decay is highest for the at-the-money options in terms of absolute value, but in terms of percentage values, time decay is highest for out-of-the-money options. And time decay only affects extrinsic value. We've already seen that. So these are the four Greeks, and these four Greeks will govern how your option prices move for the three different variables. So the price movement has two Greeks, delta and gamma, implied volatility has Vega, and time decay is theta. So Greeks are very critical for you to understand options. So let's put ourselves in the role of a pilot. The pilot needs to fly the plane from point A to point B. So the pilot needs a map that can show him where to go. Then the pilot also needs a reliable set of instruments to get him there. So the map consists of two things. One is you have your profit and loss graphs. We've seen that you can have a very visual idea of how your position is going to perform for various price movements in the stock. What we have not covered so far, and we're going to cover in a later course, is trade simulation and analysis. So for any options trade, you can tweak with these three parameters, whether it's the price of the stock, whether it's the implied volatility, or it's the passage of time. We can simulate these three parameters, and for every options trade, a trader should automatically do this until they get very, very familiar with how these positions, how these strategies are going to perform. So those are the two tools that is the pilot's map. So they know where you want to go. You want to go from point A to point B, and you have a pretty good idea of how you're going to get there. How you actually get there is through the use of these instruments. And the instruments are your Greeks. The Greeks tell you exactly how your position is going to fare under various conditions of price movement, implied volatility, and Vega. So that's what we mean by The Greeks are extremely important. They are like your pilot's instrument panel. And once you get to an advanced level in options trading, you can actually put your strategies on autopilot only using the Greeks. You don't need to know what the stock is doing. You don't need to look at any CNBC or watch the markets. Once you've gotten to that level of competency, you can just look at your position Greeks and you can manage your position. So that's how important the Greeks are. And it's critical to become a skilled options trader. You have to master the Greeks, absolutely master the Greeks. There's no other way to it. So that's the end of this lecture. In the next lecture, we're going to take up delta, and after that gamma, and then vega and theta.